I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a global technology player. Back when I first started investing, tech was kind of a no-go. A lot of investors preferred putting money to work with, say, consumer staples that sold stuff like toothpaste and cleaning product. Fast forward to 2024, it is tech. And why not? These tech companies are printing incredible numbers, and that includes this technology company. By leveraging its deep and broad product portfolio, it continues to grow its revenue, profit, and dividend. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity recently came across in shares of Skyworks Solutions Inc., which appear to be trading at a significant discount today. Skyworks Solutions Inc., stock ticker SWKS, is an analog and mixed signal semiconductor company focusing on cellular system solutions that enable wireless connectivity. Founded in 1962, Skyworks Solutions is now a $17 billion by market cap tech titan that employs nearly 10,000 people. Approximately 2/3 of the company's revenue comes from the US, whereas the other 1/3 is derived from international markets, primarily China, Taiwan, and South Korea. This is a global company with 18 design centers, 15 sales offices, and 6 manufacturing sites. Skyworks Solutions produces a large range of components that are used in various electronic devices. Its extensive product portfolio includes amplifiers, attenuators, diodes, filters, mixers, modulators, switches, and voltage regulators. It provides these products to more than 6,000 different customers. While it is diversified in terms of products and customers, the majority of the company's revenue is sourced from mobile devices that require products to enable wireless connectivity, i.e. RF. Skyworks Solutions is one of the world's RF leaders, and the increasing complexity of smartphones and networks leads to the requirement for more advanced content per device. Plus, the world is demanding more and more devices that are interconnected, i.e. IoT, through high-speed networks such as 5G. More devices requiring more advanced content per device is a powerful 1-2 demand punch for Skyworks Solutions over the coming years, which should lead to a multi-year tailwind for the company and its vast suite of products. And that should lead to lots of continued growth across its revenue, profit, and dividend. To date, the company has increased its dividend for 10 consecutive years. With a 5-year dividend growth rate of 13.2%, the company is off to a very nice start here. The dividend has been reliably growing at a high single-digit to low double-digit rate, and the most recent dividend raise of 9.7% is more evidence of that. Along with that growth, the stock offers a market-beating 2.5% yield. If you can line up a 2.5% yield and approximate 10% dividend growth, you're sitting pretty. This yield, by the way, is 70 basis points higher than its own 5-year average. The fairly large, fast-growing dividend is protected by a healthy payout ratio of 44.4%. Just solid stuff right across the board. You get yield, growth, and safety, great dividend metrics, and something to like for everyone. Looking at business growth, Skyworks Solutions advanced its revenue from $2.3 billion in fiscal year 2014 to $4.8 billion in fiscal year 2023. That's a compound annual growth rate of 8.5%. I usually look for a mid-single digit top-line growth rate from an established business like this, and Skyworks Solutions more than delivered. Meanwhile, earnings per share grew from $2.38 to $6.13 over this period, which is a compound annual growth rate of 11.1%. That's strong. We can now see how double-digit dividend growth has been powered by double-digit bottom line growth. The two numbers line up well, indicating deft control by management. Consistent buybacks help to propel excess EPS growth, with the outstanding share count down by 17% over the last decade. Hard to fault any of this. Skyworks Solutions isn't producing explosive growth, but it's been consistently great over the last decade, although the pandemic did result in a temporary boost. Looking forward, CFRA is forecasting that Skyworks Solutions will compound its earnings per share at an annual rate of 8% over the next 3 years. While that is a slight deceleration in growth relative to what's transpired over the last decade, I think it'd still be a welcome outcome for long-term shareholders. Keep in mind, the 11.1% 10-year EPS compound annual growth rate for Skyworks Solutions was improved by a temporary increase in demand, which resulted from a number of pandemic-specific events. CFRA does a pretty good job of highlighting the positives with this passage, and I quote, "Still, we like secular prospects in broad markets, on greater penetration across the automotive, infrastructure, and industrial markets, as well as the shift to Wi-Fi 6E and 7, unquote. On the other hand, CFRA notes, and I quote, "High customer concentration remains a risk, while new customer wins within the Android ecosystem are likely to come at a lower margin. Although mobile has benefited from the shift to 5G by smartphone makers, higher RF content, growth will be limited as 5G mobile adoption gains have largely already taken place," unquote. This sums it up well. Although Skyworks Solutions has an extremely deep and broad product portfolio, the company is largely reliant on sales of smartphone components, especially RF. Moreover, Skyworks Solutions is further concentrated by customer. Apple Inc., stock ticker AAPL, accounts for approximately 60% of revenue. Thus, Skyworks Solutions is largely a play on the iPhone, a highly successful play for many years. But the key risk with that is Apple continues to vertically integrate in every possible way. As Apple looks to bring more manufacturing and products in-house, Skyworks Solutions could see its growth and margins erode as it gets cut out. A victim of its own success, perhaps, but winning new customers, developing new products, and tackling new applications will be crucial for Skyworks Solutions over the coming years. Indeed, I see the broadening out of the business as the linchpin of future success. To this end, management has been taking the right steps to diversify end markets, with the $2.8 billion deal for the infrastructure and automotive business of Silicon Laboratories, stock ticker SLAB, in 2021 being a perfect example of this. Summing it all up, I don't see anything to indicate that CFRA's near-term growth projection is unrealistic. If 8% annual EPS growth is achieved over the next few years, that would easily line up the dividend for similar growth. When starting off with a 2.5% yield, you've got a compelling package of yield and growth here. As long as multiples don't compress, this is a 10% plus annualized total return setup. Moving over to the balance sheet, the company has a fantastic financial position. The long-term debt-to-equity ratio is 0.2, while the interest coverage ratio is nearly 18. While these ratios are great, they don't do full justice to the health of the balance sheet. Skyworks Solutions ended fiscal year 2023 with about $260 million in net long-term debt, which is relatively minuscule for a $17 billion company. Profitability is outstanding. Return on equity has averaged 23.7% over the last 5 years, while net margin has averaged 25.4%. Skyworks Solutions has high returns on capital, which I love to see. This is an impressive business, and with economies of scale, IP, R&D, and technological know-how, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. I see customer concentration as the biggest risk of all, as Skyworks Solutions is heavily reliant on sales to one company, Apple, which is actively trying to cut out external suppliers. The adoption of 5G has mostly played out, leaving the company with less near-term growth potential from this opportunity. The company is taking steps to diversify the business, but these steps add uncertainty and execution risks. A global sales footprint exposes the company to currency exchange rates and geopolitics. The very business model is a risk unto itself, and the company must stay ahead of the tech curve in order to not get left behind. There are definitely some risks to consider, but the growth and quality profile of the business must also be considered. And with the stock down nearly 50% from all-time highs, the attractive valuation is important to consider. The stock is trading hands for a PE ratio of 17.6. That is ultra reasonable in the land of tech, where PE ratios of 30 are not uncommon at all. It's quite a bit lower than the broader market's earnings multiple. It's also below the stock's own 5-year average price earnings ratio of 18.9. The sales multiple of 3.6 is below its own 5-year average of 4.8, and the yield, as noted earlier, is higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate rate and a long-term dividend growth rate of 7.5%. That dividend growth rate isn't as high as I can go, and I actually usually go higher for fast-growing tech businesses, with double-digit EPS and dividend growth demonstrated by the company over the last decade, as well as a near-term forecast for high single-digit earnings per share growth. This looks cautious. Well, it is cautious, and that's because of the over-reliance on a single customer that is arguably antagonistic. The diversification efforts are laudable, but it remains to be seen how that'll play out. It's certainly possible that Skyworks Solutions does better than this over the coming years, and I'd welcome the upside surprise, but I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $116.96. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates SWKS as a 4-star stock with a fair value estimate of $133. CFRE rates SWKS as a 3-star hold with a 12-month target price of $100. I came out right in the middle this time around. Averaging the three numbers out gives us a final valuation of $116.65, which would indicate the stock is possibly 8% undervalued. Here's the bottom line, guys. Skyworks Solutions Inc., stock ticker SWKS, is a high-quality tech firm that is taking laudable steps to diversify the business, and it might be one of the very last reasonably priced tech names out there. High returns on capital and a strong balance sheet give me a lot of enthusiasm about this idea. With a market-beating yield, double-digit long-term dividend growth, a healthy payout ratio, 10 consecutive years of dividend increases, and the potential that shares are 8% undervalued, long-term dividend growth investors looking to up their tech exposure without overpaying should be looking at this name. And now for a special news announcement. ASML Holding NV, stock ticker ASML, just reported a great quarter, showing a more than tripling in net bookings quarter over quarter. We covered ASML only a few months ago, highlighting it as a world-class business on sale. Shares are up substantially since then, but if you don't yet have ASML in your portfolio, it'd be a good idea to keep this one on your radar and consider jumping on the dips. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is and am often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from the same exact stocks that I own. So if you think this is something that you could benefit from as well, check out the link in the description to see my portfolio and start getting my buy and sell alert. I'll see you next time.